What is going on, you guys? It's BGFX. Welcome back to the channel, and salute to all you guys who are watching. In today's video, I'm actually going to be going through a few different trade ideas that I definitely think could take your trade to the next level. So in this video, we're going to get into a few concepts about liquidity. We're going to go ahead and talk about wyckoff. We're going to talk about supply and demand. I'm going to talk to you guys about how to buy and sell off of highs or lows depending on what market structure looks like, and also tell you a little bit about when you should be and when you should be entering the market based off the strategy I like to trade, of course, because there's so many different ways to approach the market. I personally feel that there's no such thing as a holy grail, and a lot of it depends on psychology. Although there is something called strategic dominance, which makes some strategies better than others. But once again, it's all about finding what works for you. So I'm going to explain to you guys a little bit about the way that I actually like to approach the market. So let's go ahead and get into it. Like I said, this video is going to be a little bit different. If you're familiar with my channel, you know that I like to post videos kind of recapping trades that I've already taken and kind of giving you a backstory behind each one. But in this video, I'm actually going to focus purely on the educational side of things. So if you do enjoy, make sure to hit the like button, make sure to hit the subscribe button, and we're going to go ahead and get right into it, right? So looking at GBP/JPY right now, we're actually on the 30-minute chart, and I'm going to show you guys how you could have actually took advantage of this structure right here. So we're going to rewind the charts real quick and understand that this is all stuff that already happened. So I know I'm explaining it after the fact, but I'm just going to talk to you guys about the way I personally approach it. Okay, so we're going to talk about selling or the way you should approach a market when it's making new highs, right? You can potentially sell off of new highs, and there's an underlying reason to why you can do this so well. And it's kind of based on liquidity, right? So if we go ahead and we come over here, you can see that the market made highs around 139.845. What I like to do is I like to look for that potential next high to catch the retracement off of, because the retracement is usually very strong, right? Retracements usually take out lows of some sort in certain types of trends, right? We know that the books will teach you that market structure typically looks like this, right? Impulse correction, and it would kind of be like A, B, C, D, E type of move, breakout, pullback, breakout, pullback. But we know, or anyone who looks at the market knows, that it doesn't really happen that perfect every time, and there's a reasoning for this, right? The markets typically move based off of unseen factors, right? Forex is decentralized, so we cannot see open orders of what traders are doing. So typically the market is kind of making this exchange for whatever direction it wants to go. So in this case, you can see that we had the double top, and most likely what this double top did was it created a point of interest for most, technical traders, right? Most traders who trade technicals would call this a double top. Market comes up and pretty much just rage right through the double top very strongly. And also just go ahead and take note of how big this bullish candle is, just signaling out that there was a lot of volume coming in, spiking out, maybe consolidating, breaking new highs, and then coming back, and then potentially showing you a couple opportunities. So what I'm going to be talking about a little bit here in a second is how to capitalize on this move, how to capitalize on this move, and things of that nature, mainly focusing on the highs and lows of a structural trend, right? So like I said, liquidity, I would just put EQH, which stands for equal highs, and then we also have a little area of supply here, right? Little area of supply that I would draw out, which is different than support resistance, right? If you don't know what supply and demand is, I do have some videos in the past that I did cover that. But basically the market likes to do a few different things when it comes up to a previous level of structure or a previous high, right? It'll do either, it'll create this high, it'll come down or come back up, and it will fail to make equal highs, right? That's going to be scenario one. And when this happens, typically you will be looking to short coming back down to catch the move back to the downside. Now understand, when I say this, I'm talking about every time frame, so each time frame should be approached a little bit differently, right? But you can see for the most part, this is basically when sellers are in strong control and the market is going to neglect to pick up any orders by touching price a second time, or neglecting to pick up any liquidity by breaking through price, it'll just typically fail to make an equal high. Okay, that's going to be scenario one, and I'm going to go ahead and I'm going to keep that right there. Okay, scenario two, what price will do around a high, this is very simple as well. This is a double top. This is what we see actually occur right here. Double tops are known for creating liquidity in the market, creating points of interest for price to typically react to in the future, right? You'll see if the market wants to trend and go ahead and make a reversal to the downside, it's not going to just make the double top every time and then come back down. So back to what I was saying, the markets are moving based off of unseen factors. There's a lot of data going in and out where money's at in certain situations. So in this case, you can see that the market actually created the equal highs and pretty much broke through structure that would look something like this, initiate a lot of sellers. But if for any reason sellers were very strong and we did not have enough buy side money coming into the markets to provide this move, the market is going to go ahead and it's going to pick up those sellers. Okay, maybe trigger some buyers, do what it has to do, and then come back to the downside. So there's strategies, right? There's stuff that you would call wyckoff, accumulation, distribution, support, resistance. There's trend lines. There's different things that people use. But the way that I like to personally think of it is that this doesn't move the market, okay? The market doesn't move because of wyckoff. Wyckoff was created because of people, or because of things that Richard D. Wyckoff noticed about the market. So it's not like the market is destined to move, or one thing you see in the market is due to a specific thing happening. It's all due to underlying causes, you know what I mean? So back to what I was saying, guys, I don't want to get too off topic here, but you can see that the market either failed to make equal highs, and this would pretty much be like supply demand factors in the market. The market can then either make a double top, right? And this could either be because the level of resistance is strong, or because the market wants to come and it wants to pick up liquidity. And there's ways that we treat that, right? There's certain ways that we approach this, and that would be like your strong resistance slash liquidity creating scenario. And then the next thing is going to be the market's going to come up and it's going to blast through equal highs, and then maybe it'll come back down. And then last but not least, you have your very simple trend, which is impulse, correction, impulse, and then a trend continuing to the upside. So those are the things you want to keep an eye on when market comes up to new structural highs, right? So in this case, we have our equal highs, but we also have right here what I would look as a demand zone. Okay, understand that people look at these differently. Some people would call this an ICT bearish order block, right? So in that we have the up candles here, sometimes a consolidation before a strong drop off. In this case, I would just look at it as demand. Okay, I look at supply and demand in the market, typically very similar in that way of looking at things, right? Similar to right here, we can see that price reacts to this level and pushes back up, something like that. Okay, so back to what I was saying, right? We have the markets coming up making equal highs, and we didn't take out this level. Okay, so you can see that this move here would have most likely provided the liquidity for this longer term move down. So if we go ahead and we come over here, we could look at this market that made this structural high here around 140.335. Now, understanding that the way the market moves, like I was just saying, the market can either fail to make equal highs, it can purge through this high here and then sell off. And there's a reasoning and a way you want to look at the market for each thing that it does. So this move here can potentially be setting us up for a longer term bullish move, or it can be setting us up for a sell-off, right, to pick up any liquidity that was gathered right here. And you can even see that the trend line that was created was respected on multiple occasions. So it's very possible that the market's going to come up, is going to exchange some of those orders, and it's going to look something like that. So in this case, right, if you haven't seen my wyckoff video, I do have a video covering wyckoff. I talk a little bit about accumulation and distribution, which is very simple forms of wyckoff. But okay, let's go ahead and look at what we have here. This is what I would call my buyer's climax. Okay, this is my buyer's climax. This is what we would call preliminary supply. This is what we have as a potential little contraction phase, market not really doing too much. And then we have my upthrust. And then next we have my upthrust after distribution. Now understand, when you are looking at wyckoff, and then one more thing, we have most likely a secondary test here. I'm not going to name every single phase, but then some people call this automatic rally from here up to those highs. And then from that point, right, you pretty much have your overall potential distribution coming into play around this previous high, right? So that's kind of the way I like to approach it. When I see the market, you know, surpassing this level of structure, I'm not looking to specifically buy or specifically sell. I'm letting the market tell me its story, and I'm going to enter from there. And then once again, the markets do not move because of wyckoff. So wyckoff is just a tool that allows you to kind of understand and kind of build a bias of what you think price is going to do once it does create those highs, right? So if we come down really quick and we come back down to like the 5 minute or so, and we get a closer look at the market, you can see that you know, there's finer details to why the market moves the way it does and why this trend is going to potentially be transitioning. So even if we look back down here, we can draw out this level, and this will also be equal lows, which also makes sense as another area of liquidity once again. So if the market does want to exchange itself and want to be bullish over the long term, like I said, there's most likely underlying reasons for why the market isn't going to go back to the upside. So what it will potentially do is it'll reverse, it'll come over here and it'll pick up liquidity from the equal lows. And then you also obviously have what people would call imbalance, right? Imbalance in the market. You can see that we had this huge bullish candle, we had tests from here, and this whole area hasn't been touched, right? So if we zoom in, you can see that this entire area here is pretty much a very fresh level of price. So there's no real reason for people to put orders into the market around this time, right? If you just look here, like, no one would be trading around here aside from people placing sell stops. Okay, now this is a concept of liquidity. If we come over here back to the 15-minute, you can go ahead and just put sell stops, and it's a very common reason for why sell stops and also stop losses reside above and below equal highs / lows, right? So in this case, in the future, traders will potentially do something like this, right? And they would place a pending order for price to potentially pick up on buys once it continues back to the downside, right? And there's a reason this happens, and that's because if you look in the past, right, of what happens around equal highs, you can see that right here, right? Market creates a point of interest, a double top, and the market blasts right through these equal highs. So if for any reason you did have what we would call buy stops, right? You enter with a buy stop, you can see the market literally ran almost 45 pips in your direction. And pretty much every time the market picks up those orders, is going to do it time and time again, because that is what traders do, right? That's the way traders think. Okay, and no matter how many people trade these concepts, they're still going to have people with buy stops, sell stops. They're still going to have people with limit orders in the market who trade the traditional methods, because understand that as traders, we are human. We all believe in different forms of approaching things, right? There's different personality traits. Not everyone is going to be favorable to trade wyckoff or methods like this. Some people think it's too complicated. Some people don't believe in it. Some people much rather trade support, resistance, trend lines, and nothing is wrong with that. Like I was saying, because those things may have not worked for me to the fullest, but there's no way that I can say that it's not going to work for everybody, even though my approach, or this approach, is used to somewhat use traditional traders to your advantage, because this is more of a fact of the way that the market moves. Okay, now some of it's theory, of course, you know, wyckoff theory. A lot of this is theory, but at the same time, it just makes so much sense that the market needs to move this way to provide liquidity to move in certain directions. So back to what I was saying, potentially if we do have this wyckoff distribution, the next thing that you're looking for most likely is going to be an area for entry, right? So you could target back down this level, and essentially what you're doing here is, instead of coming to the market and saying, okay, I'm going to sell right here, I'm going to put my stop loss up here around this level or above these highs, and I'm going to put my take profit all the way down here to see if the market gets bearish. So understanding, right, the overall reasoning to why someone would trade like this is, it's simple. Okay, you don't have to stare at the charts for too long. You don't have to sit here and look at the markets. You can literally place your stop, place your entry, take profit, and from that point you wait. Okay, instead of us having a 59 pip stop loss, we're identifying the individual phases of the market, and we're looking for the best entry possible, which means you do need to spend more chart time. You need to have more time on the charts, and it's more difficult. Okay, understanding that if you're entering with a 3 to 5 pip stop loss, it's a more difficult style of trading. You're gonna need to be able to take losses, cut them very quick, so that you could allow your edge to play out. So in this case, right, looking at the potential wyckoff distribution, we want to come down to a lower time frame, and I would need a reason to enter here. Okay, essentially I would just need some type of reasoning to why I would want to enter, and most likely my entry would be right about here at the close of this bearish candle, right there at the close of this bearish candle. So if we come back over here, that will pretty much be my last point of supply in the market. So that's what you call it, right? The last point of interest before price sells off. You could put LPS, last point of supply, and it would look something like this, right? And then another thing you can use is you can use Fibs, right? You can also use Fibs, and you can see that we do have a little bit confluence with our last point of supply, which is 786. and my entry would obviously be a little bit above that, okay? And then I'll remove my fibs, and then I would either set a pending order here, or I would just manually enter. Okay, me as a trader, I'm much more comfortable with manually entering. Something about it, I just like to be more in control of my trading. I don't really like the idea of setting an order and then walking away, because you never know how the market's going to act, right? I also use mental stops. I don't use physical stops. I always examine and close out the markets on my own. Okay, so looking at what we have over here, just one quick recap, you can see the market creating new highs, and that's when our potential wyckoff distribution began to form. Okay, you can see that we had that preliminary supply. We have the buyer's climax. Now, looking at the buyer's climax, what do we do here? We create those equal highs. We pretty much range and form this contraction right above there, pick up liquidity, kind of give us a little bit of uncertainty, and then this is what we would call contraction phase, and then a little bit of expansion right here, market picking up both sides of liquidity once again. So you can see that from this contraction, we trigger more buyers, and then we expanded all the way back down to the downside. But understand that this was still a strong level of support from that point. So necessarily, I wouldn't say that all liquidity was taken out, but we tested this strong level, maybe picked up more buy orders, and then from that point, this entire schematic here would give us a potential reversal. And that's how we would catch our entry, and it makes such a big difference, because if you look at the way a lot of people trade, a lot of people say keep it simple, and nothing's wrong with that. But if you were to do something like this, you could call this like a ascending channel. Price breaks out of the ascending channel, they wait for a test, and then they come back to the downside, right? But the difference between using a method like this and using traditional simple approaches is that your stop loss would probably be up here, and it makes such a huge difference. And you would probably go from targeting liquidity above or below these equal lows, and this is what a traditional entry would look like if you were trading in ascending channel, right? In this case, this is our last point of supply, so the wyckoff methodology tells you that last point of supply is going to be the last point, so there's no reason to have a stop above that, and my stop loss will look something like this, right? And the risk to reward is 1 to 36.02, and if we were to zoom in a little bit more, I would most likely kind of check my stops, and you can see that it was a little bit in confluence with this wick. So for me, this is enough. Okay, this is enough for me to get my entry. This is enough confirmation. And you would also see something like this. So if you look at the market from multiple directions, you would also see like a rising pennant pattern, or whatever you want to call this. And then potentially traders will want to see this break out to the upside. Some people want to break out to the downside. So the most important thing is forming and understanding the way that you want to look at the markets. No one else's opinion matters, because you're an independent trader. You know what I mean? So getting good at what you see is the best possible thing. So sell stops, equal lows, and then having this upside trend taking out this high, but still respecting this level, right? And then if we come over here, you can also see that we have another area of supply, which was the initial move to why this market decided to push off so strongly for us. Okay, now understand that if the market does come up and make new highs from this first point of supply, usually that will give you a little bit of possibility that the market's going to become bullish. However, understand that just because the supply level isn't as fresh, it's not like it came up and it created equal highs, because usually it would raid after the equal highs. But in this case, we actually take out those highs, but we're still trading in the range of this, first point of supply, which was at the highest point of a trend, right? So if we go ahead and we press play, I'll show you something of what this trade would actually look like, and we'll actually go down to the 15-minute real quick. And from this point, I would either enter on market execution, or I would just set a limit. Okay, and boom. So from that point, we would be triggered at 140.316. right, 140.316. I'll just leave it right there at 315, and you can see that we're now triggering it. And from this point, right, we just want to see how we take on this range of market structure right around these highs. So like I said, two things can happen. You can see the market come back up, pull back just like that. Sometimes it'll break through both sides, you have another potential contraction, expansion, then you'll have that follow through, and then sometimes it'll just look something like that, and you'll have that perfect reversal. Okay, so from there you press play, and you can see how the market instantly took out this level. So from this point, stops are going to break even, and essentially my risk is out of the markets. And at this point, we're running very nice in the profits. And depending on how market structure looks, I would probably take a little bit of partial profits. But you can see at this point, beautiful entry, very, very nice reaction to our level. But the most important thing to understand about trading this approach, if you're trading liquidity concepts, you're trading liquidity. So the idea is that you need to let 90% of people do what they're doing. You need to let everyone else into their positions, and then once that point comes, you need to be the most patient person in the room, and you execute when you see the opportunity given to trade kind of with the flow against that. So you can see that from there. Once again, we target liquidity, right? Take profits, hit at this area that we said potential buyers or potential sellers, I'm sorry, were going to be coming in because we did have equal lows. And then from that point, you know, me personally, I would have got out of my full position most likely at a 1-35. Okay, understanding that, I probably wouldn't have held all the way down to here. But once again, like I said, we probably had a little bit of market imbalance, so you could have held past that. But to me, there would have been no reason to potentially go back down to there. I would have been perfectly fine with taking this liquidity, securing my profits around a 1-36, and it would have looked something like that. So really quick, I want you guys to examine the way that the market's actually moving and noticing how prices break and retesting, and then we kind of have that nice little reversal and we have that nice turnover in the market. So it wasn't like we were looking for a perfect head and shoulders. It wasn't anything like that. We were looking at the phases. We were looking at how market responded to what was going on. And once we finally have everything set up, that's when we would sell. So you'll hear a lot of people say wyckoff is hindsight. And the reasoning that I don't believe this is hindsight is because you do not just put your buying climax or your preliminary supply right away. Okay, if all of this did not happen and the market was only right here, I would not be looking at this as a buyer's climax, right? It's not until the upthrust after distribution comes that I put the pieces together and I line everything up for my potential trade opportunity back to the downside, right? So really quick, like I was saying though, we noticed that we had this bullish trend and we have the turnover. Okay, look at this very closely, and if we come right over here to the left, you can see the same exact structure, and we have that turnover back to the downside. So once again, that could be another form of confirmation. You can see that the market is very fractal, right? What happened over the long term literally repeated itself within 30 minutes right here at this area. And you can see that from that point, price took out previous lows. Okay, looking at this level, price met the last point of supply, broke lows. Okay, look over here, price met the level, and you would just essentially look at the sell stops from that area, and then it would take out liquidity from there. So understand the fractal nature of the markets literally turned over in the exact same way right next to each other. So that is pretty much it for this idea, guys. And like I said, very simple wyckoff distribution off the highs, looking at supply demand, understand where the liquidity is coming from. Okay, so next we are going to be looking at a 1 minute scenario. This was a trade that actually took place this past week on GBP/JPY, right? So if we're looking at the 30 minute, essentially you can see that once again we took our market structure highs again. So understanding that once again you can trade with the flow of the markets. You can trade this, right? This is a time and place for trading with the flow, but once again you want to be mindful of things like this, right? The market kind of snapping back to the downside before it goes with the long-term move. But in this case, right, once again we make highs again, and we push above these highs, and we have this little phase of consolidation. Okay, we had this little phase of consolidation right here, and when we go down to the lower time frame, you're gonna understand exactly why this happened. And then once again we have this another phase of consolidation where price actually retested and then continue back to the upside. So if we go ahead and we look at the markets right here, you could see that once again the market created liquidity on both sides, and most likely people were going to want to see price break out back to the upside, and some people are going to see price break out back to the downside, right? That's what their bias is going to be. So once again, understand that as a trader, you don't have to feel like you're the only one looking at the markets. Like, and what I mean by that is there's going to be people who want to buy this, there's going to be people who want to sell this. So I'm not going to say don't feel like you're the only one, but don't feel like you can't create your own opinion, because every trader has a different reason for why they're looking at the charts. It doesn't make them wrong because they want to sell when you buy. It's just, you know, that's what literally makes the markets go around, right? Sometimes people are wrong, sometimes people are right. Whoever's right over the long term, the money slowly gets transferred into their hands, right? So back to what I was saying, little phase of consolidation, and then from this point we do pick up liquidity from both sides of the market, and it will potentially look something like that. And for me personally, I usually don't trade these when the market picks up liquidity from both sides. What I do is I'll literally sit back. It doesn't matter how long I have to sit back. If I have to sit back through all of this, I will. And once I see my opportunity come, I will look for something like that. Okay, I'm only looking for the perfect trade opportunities, right? The only things you can control as a trader and I say this all the time, is how much you risk, what trades you take, and what you respond to what does or what doesn't go your way. Okay, so notice what we have here, we already take out highs of previous market structure. And back to what I was saying, right, in the previous one, we had wyckoff distribution giving us that turnover back to the downside. In this case, we take out highs, and it's very simple. We only consolidate through both directions, and then we go ahead and expand through both sides. So from this area, what I would do essentially is, once again, I'm trying to map off of last point of supply. Okay, you can see that we have this up candle here, a little bit of ranging, and those wicks kind of catch my attention. So once we see price come back, you see that we have a little bit of reaction, and then some people would also say that we have like a trend line going here. Okay, so if we come back to the 1 minute, what I would essentially do is, once again, talking about the fractal nature of the market, when we were looking at this huge turnover in the market, it looks very similar to this 30-minute turnover. Okay, very similar here. We have the range, hit both sides of liquidity, come back up, continue to the downside. If we zoom into what we have here, we have range, hit both sides, liquidity, potentially come up. So for me, that's enough confirmation to pretty much go for a trade. Also understand that we're touching a potential last point of supply, right? And it will look something like that. And then also, if you look at our sessions, you can see that pretty much this is coming to an end. So this is a little bit in the afternoon, and this was pretty much at the end of the week, right? This was a Friday. So looking at the high today, we're looking at the last point of supply from the highest point. And then from there, what I would do essentially is I would just take a fib, most likely, and we would see where I would want to enter at. And once again, I would probably just use the candle in this case. My entry would be a little bit above here. Stop loss would be probably 2 pips, because once again, my idea isn't that I want to see equal highs. At that point, if the market does want to come back up, it'll probably trade much higher, and then from that point, it will give me a little bit of it'll give me a sense of, okay, I'm out of the markets, I can just get back in whenever my rules are met. Okay, don't live and die by each single trade. And then once again, price might be able to come back up to here. So instead of me sacrificing my risk to reward by having like a 16 pip stop loss, at this point I would probably have maybe like a 2 pip stop loss. And then from that point, I would probably look to target this area right here. Once again, so entry would be 141.208, and then things like that. So since this was a Friday, I would not really be wanting to hold this that long. Okay, if you wanted to, once again, you could have even targeted below this range. If we go to the sessions, this was our Asian range, right? Market likes to come back, blast through the Asian range, provide liquidity for a longer term move, and I'll talk a little bit about that in a second. But once again, we had the market pick up both sides of liquidity, and this is the last point of supply from that. Okay, so my entry is going to be here, and all I'm looking for is price to potentially turn over. Maybe it'll come back up, but from that point, I just want to get out of my trade. I want to secure my profits around the 1 to 12. So if we press play, we'll see what price does. And from this point, trade is still valid because we're now creating equal lows and we're reacting to this level of structure right here. Okay, so understand, when your entries are this tight, you got to befriend losses. Okay, it's not going to go every single time in your direction. But boom, so there we're triggered, and then now we're coming back to the downside, and we're risk free already, and trade would be finished. So understand that this is the ideal scenario, right? This is just literally a perfect trade setup. It's not going to look like this every time. Okay, the most important thing to do when you're trading liquidity concepts is wait. You need to be waiting. Most traders cannot wait. Most traders cannot sit on their hands and let the markets do their thing. Never approach the markets with a paycheck mentality, feeling like you need to pull money out of the markets every week or every day, because that's not what it is, right? The markets is very random. I'll be completely honest. Some weeks you won't get paid at all. Some weeks you will be overwhelmed with the amount of money you make, okay, depending on how long you've been in the markets, of course. But understanding that the markets are random, you need to approach them very selectively and only enter when you see literally the perfect opportunity, because that's some of the only things you can control as a trader, is when you enter and how much you risk, etc. And then once again, we have this perfect break and retest, maybe pick up some buy orders, and then from there snatch the buyers out, and it would look something like that. So this was a 1 to 12, this one here was a 1 to 36, and then next we have a concept right here on the 30-minute time frame, which was somewhat of equal highs, right? So once again, it's all circumstantial and it's all dependent on the individual trade setup, right? When you're trading these concepts, you don't have to trade everything by the books. It's what's more important is what's going on in the mind of a trader and how adaptable they can be to each individual circumstance. So in this case, we have equal highs, And in this case here, I said this is equal highs. I probably wouldn't want to trade it until we purge the highs. You see what I mean? So coming back over here, there's a small difference that would kind of allow me to want to trade it. And what I would do here is I would just essentially map off this level here, just like that, this little mini area of supply in the market. You see these wicks, this close of this candle, perfectly showing us reaction. But once again, understanding this, you can see that the market is going to create potential liquidity. So if for any reason the market does want to continue to the downside, we need to understand that, once again, as unseen reasonings, if for any reason the market needs this liquidity for a longer term move, it'll come up and it'll pick it up. And then maybe there'll be open orders here, people who want to enter on a head and shoulders pattern. So the market might neglect to pick up those orders before going back to the downside. Okay, very simple. And then once again, we'd erase this really quick. And what I would essentially do is I would just come back down to the lower time frame. You know, I would just come back down to the lower time frame. And I'm gonna probably have to go ahead and wind some of this because that looks like my trade opportunity. So in this case, right, we could see that the market somewhat gave us this level here. Okay, the market creates equal highs here. Once again, very fractal. Okay, very fractal nature of the market's kind of giving us a clue, is that if we look at this structure here, you can see that we created equal highs, and then what do? Break through the equal highs and then melt off. If we come back to the 30-minute, literally the same thing. Break through the equal highs here and then potentially melt off. So the market's giving you a hint. Now that doesn't mean that's going to happen, but if you have the right amount of confluence, you could use that as another form of entry confirmation. So in this case, you can see that the market breaks through these equal highs, and once again, it's testing a strong area of supply. From here, I would just want to look to the left, and I would want to ask myself, is there any reason for me to potentially want to sell this market? In this case, you can see it's just a very simple idea here. So for me, what I would want to do in this case is I would wait for a break of structure. So you could see right here that this looks like a potential head and shoulders pattern. I don't really feel comfortable entering on that, especially with somewhat equal level of structure. So in this case, I would be adaptable. And once again, adaptability is something that you can teach a little bit, but you need this from experience. So in this case, I would wait for a break of structure. And once again, you could have entered here. If you wanted to enter around this area and just took short back to the downside, you would want to put your stop loss around here, okay? And that would have literally been like a 2-pip stop loss. So that's why I like micro market structure so much, is because of things like that. So instead of me doing this, I would essentially take a fib. We're gonna go with a break of structure entry, and I would just do 705, right? 705 entry. Stop loss. Stop loss will really depend. If I wanted to be safe, I would do it a 6-pip stop loss, and if I wanted to be much more aggressive, I would just do it right here for 1.9 pips, and then take profit would be most likely somewhere around here, and it would look something like this. Okay, but once again, this is something that has to be gained through experience. Not everyone's going to be able to enter with a 2-pip stop loss. Some people believe that it's just simply not possible, but no, you'll see it happen time and time again if you're trading in 1 minute. So looking for price to make that pull back. Boom, so there we're triggered. Okay, we're now triggered from there. And of course, I already know that the market's probably going to react to this area, but another possibility is that we come higher and then we sell off, and then another possibility is that we just remain bullish, and then another one is that we remain bullish, then sell off from here. But once again, it all depends what the higher time frame looks like as well. Just because we're trading in 1 minute, we do need a very good understanding of what's going on the hourly and the 4-hour and the daily, so we can get that bias of when the market is actually trending, when it's going to potentially pull back, and things of that nature. So we have some reaction here, and then boom, we're risk free already if you have a bearish candle that size. And from that point, boom, take profits and now hit. And once again, if you want to hold longer, you could have. Me personally, I would have been in and out from there, and you can see the market still picking up the opposite side orders from this range here. And this was still Asia, right? This was an Asia session trade. So just a quick recap of this, right? Market makes this high, creates the first point of supply, creates equal highs, doesn't really trade into it enough. From this point, we create the range, we pick up liquidity from the upside, pull back, create new highs around this last point of supply, and then we break structure from a head and shoulders, pull back with the fib, pick up liquidity from the downside. Okay, so very simple. And we're gonna go through one more trade, right? So we're gonna show you how, or I'm gonna show you how we're gonna approach this, right, around equal highs, and whether or not I want to trade it, whether I want to buy, whether I want to sell, based off what the market shows me. Okay, so in this case, we can see that once again the market likes to move around highs, right? You see what I mean? We create this high, we pull back, boom, it falls off. We create new high, it falls off again. Create new highs, it falls off again. But that doesn't mean you want to get rid of this right here. You can still look for trades with the trend, but essentially when you're talking about liquidity, most liquidity is going to be picked up around strong levels of support resistance. So back to what we were saying here. If you wanted to, you can go ahead and look at, let's see if I can find this tool. Okay, maybe not. Okay, but look, you can go ahead and see that what does order flow look like it's doing. For the most part, it's continuing to the upside. So for me personally, I would have a bias just based off of experience after this huge bullish candle that the market is probably going to push to the upside. You can see that we have a little bit of reaction at first from this area of supply. And I'll go ahead and take this off really quick. And you can see that the market pretty much rejected around 40, about 40, 50 pips. So my bias at this point is that since we do create reaction from the supply and then we push back up, there's a good chance that the market is probably just going to continue up from there. So instead of me looking to sell around the high, potentially I would just look to long it. So now when we're coming back at the 30-minute, what do we see happening here? Equal highs being created in the markets. We already know equal highs create potential liquidity. I'm just going to abbreviate that for y'all. So equal highs will create potential liquidity, and then we're going to look at our sessions and we're going to want to see what happens. So I talked about this in my previous video, and you can see that we have a perfect break and retest during Asia. The Asia break and retest. You'll notice these different things happen on multiple occasions, but you can see that from this point the market breaks, it retests, and from here you would assume that the market pretty much picked up buy orders, and then you can also see like a mini demand zone right here. And from this area, right, buy orders are pretty much now sitting in the market. So if the market does want to move up for any reason, it'll most likely come down and pick up liquidity. But once again, this is unseen factors, so we don't know this. There's no way for me to say the market's going to have to pick up liquidity, because this is coming from data and computers that know that it needs to do this in order to provide a certain directional bias or a certain directional weight. And some people believe this is all theory, okay? But the most important thing is to understand what works for you. This 100% works for me. But back to what I was saying, right? We notice the area of demand, we push back up, market picks up buy orders, and then what do we do right here? The market then mitigates those buy orders, potentially takes any of those buyers out right here, and now we are in London, right? So looking at what we have here, you can see the market is going to give us a small transition here, and it's going to go from sell side movement, right, lower highs, lower lows, into approaching, after it takes out this liquidity, back into a potential upside move, and it would look something like that. So where would I want to enter here? Obviously your first point of entry would have probably wanted to been somewhere around this level to catch the move back up. But if you want to go ahead and you want to wait for a little bit more confirmation, you can went down to the 1 minute, and your best entry, your best bet would have been entering right here, and this would have probably been the last or the best point of entry, because this right here was missed. Okay, this little area of potential demand was missed. Stop loss would have been right here, and then very simple, like I said, I'm targeting liquidity above, and this is something I talked about in the previous video. But looking at the 30-minute, this is how you set yourself up for the move, okay? Understanding how liquidity moves, because in these cases we wanted to sell, but it's because the markets were telling us a story that potentially selling was the best option based off of liquidity concepts, okay? Back to what I was saying here, equal highs, demand, market kind of gives us the structural turnover. Fractal nature of the market show you the same thing. Wyckoff distribution, imbalance, hit sell stops, things of that nature. The market also needs to take out some of the liquidity that was created here as the market came back up. Okay, same thing here, except the market's telling me a completely different story, so I wouldn't want to short. Okay, equal highs, once again, that's just giving me a red flag that potentially that can be taken out and buy orders can be hit. So if we go ahead and we press play here, and let's just say you wanted to target above these equal highs, understanding that the market, people trading the market algos, whatever it is, has pending orders here. Like I said, there's going to be pending orders for someone to take advantage of when the market breaks out. And then people will think all the time, well, if this is somehow something that works, why do people constantly place buy stops above previous highs? Just like I was saying, if we press play right here, I'll show you guys exactly why. Boom, buy stops picked up, and take profits were almost hit. So in that case, this was about 20 pips, simple, for anyone trading that way and wanted to catch the breakout. It would have been as simple as that, and it would have been in and out. And that's actually a very common way of trading, you know, the London breakout. So instead of me looking to catch the London breakout, I'm putting 2 and 2 together before that happens so I can catch the move. And from that point, I'm already risk free. And if the market does want to continue up, we already have open orders in the markets, and we're actually in the markets after the manipulation happened. You see what I mean? So we run less a risk of getting stopped out at break even, and which is another reason why our stops are so tight, because we're not trading with the idea of the market may come back down, mess around, and come back up. We're letting the market do what it has to do, then we enter. Okay, so key takeaways from this: understand liquidity, be very, very patient about what type of trades you enter. Be very, very selective. Understand that no one is telling you that you need to enter a trade. There's no reason for you to rush. The markets are always going to come with opportunities. If you miss an opportunity, if you miss an entry, understand another one is literally in the process of setting up. Okay, that's just the way the market works. The only thing you can control is how much you enter, how many trades you enter, what you respond, or the way you respond to what does or what doesn't go your way, and how much you risk. You know, it's very consistent, and you need to master those things, and also just train your eyes to see these type of things going on in the markets, man. So that is pretty much it. It's been BGFX. I hope y'all did enjoy this video. If you did enjoy, you know, I wanted to focus a little more on education in this video. I didn't want to go through any trades I entered or anything like that. So this was purely based around getting better, understanding the charts at a higher level, raising your market IQ. Like I said, if you did enjoy it, all you got to do is hit the like button, subscribe, drop any comment you have down below. And I also want to say one more thing. You know, if you did get some value from this video, I get the question all the time in my DMs. People message me this, people comment this. They ask me, do I have a course? Yes, I do have a course. I don't really mention it too much in my videos, but yes, I have a course that goes through stuff similar to this, a little more in detail. And it's usually updated with content regularly, and this comes with my course. But not only does it come with a course, it actually comes with trade alerts. So when I enter a trade, I pretty much notify anyone in the program, man. So yeah, I just want to get that right out the way. I don't really advertise it too much. I don't want to come off as like a salesman type. You know, I don't really market it that much. But if you are interested, if you feel like I can help you, and if you want to take your trading to the next level, this is a lot of what I know right here. If you want to learn more, I have a link right down in the description, and it's $100 monthly or $400 one-time fee, which is lifetime, that actually raises very soon. But hey, I just wanted to put it out there if y'all were interested. But that's pretty much it, man. I hope y'all did enjoy this video. Hope I definitely helped you trade and took it to the next level. I'll catch you guys in the next video. It's been your boy BGFX. I'm out. Salute.